You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good morning, Jim.
Bob, we're highlighting the widening credit spreads that we talked about earlier.
Yeah, well, we should just review this one because it's something that the equity guys don't really look at, but it has it can hit the markets. And also, the key thing about credit spreads is that when it gets serious, there is no example in history of the senior central bank ever preventing the reversal in credit spreads to widening that will eventually bring down a stock market and a business cycle. So anyways, we watch it closely, and for this year, we're expecting spreads to narrow with confidence. That's the difference between high-grade bonds and low-grade bonds, and then you're in good times, you figure the low-grade guys can pay the interest. So at any rate, spreads narrowed into May, June, and then turned to widening. And this is important when you're in very excited financial markets. So we looked at it compared to 1998, which was the year that long-term capital management got in the wrong place at the wrong time and blew up. It was the biggest failure for a hedge fund to that date, and they were playing the convergence, whereby European policymakers would narrow all the credit spreads in Europe and everything else around the world too, and these guys were highly leveraged on it, and the trade started to go against them. Then in 2007, the turn to credit spreads started that collapse, and in 2008, the turn in credit spreads really pushed off the full crash. So we watch it very closely, and to follow the model on each of those years, you would expect the turn to widening in early June, which we've got. Then on the chart, making the initial breakout in early July, which we did get. And then after some churning around, then in late July, early August, you'd make the really critical breakout. And that's happening right now, because when junk bonds panicked earlier in the year with the crash in crude oil, that spread over treasuries got out to 213 basis points. And as of yesterday's posting, that's at 216. Now, 3 ticks is not a big number, but hey, it's a breakout. So this now is in pretty strong warning mode, and we'll just keep watching it go up. The other one is that the yield curve, the difference between treasuries, long-term and short-term, that's also changing as a warning. So, and then on top of that, you've got weak commodities with, for example, crude oil making new lows this week. So the combination of weak commodity prices and widening credit spreads, I think, is waving the danger flag here now. But what you usually get here, this late August into early September, there can be a positive pulse come through the markets. You kind of get a lot of fund managers off on holiday, come back early in the first week in September and say, oh, look at all that wonderful value out there, and stop buying, and then bang, that's it. So that's what we've been looking for. The historical side was looking for the huge speculation in outlying markets like China was likely to blow out in June, and it did. And then we've had what we've called the friends of the bull market, which was that the margin debt outstanding soared up as speculation soared, and it peaked in April, and then it reversed in May. So then that becomes a count that in past bull markets, when the margin debt was being laid on, from the peak to the top of the stock market is usually some months after the peak in margin. So that some months counts out to somewhere around now. And the other one that was with that was the advanced decline lines on the New York Stock Exchange, which also peaked in April. And typically that one tops out some months before the actual high in the senior indexes. So we've got that. So that then counts out to the final last attempt to rally the thing. Likely will come in over the next couple of weeks, and if that spread continues to widen, or let's put it this way, the next surge of widening could be accompanied by the discovery of somebody really offside in the financial markets. And you really can't tell ahead of time what the name's going to be, but there will be people there. I saw one a couple of weeks ago, some hedge fund guy that was essentially playing commodities and stuff like that. And the assets under administration in 2 years went from $2 billion down to about $180 million. I mean, this is a huge shrinkage in that business. So we'll watch for that. Then also there's been items like the IBB, the biotechs have been sensational, and the media stocks have been outstanding, and they have been taking some cracks lately. So with the advanced declines narrowing, it means the bulls can only push up fewer and fewer stocks, so you focus on the ones that rise. And this thing could, usually later in September and October, after you've had this kind of a party, is when you begin to discover the hangovers. So we just as soon not have a hangover, so the idea is to be lightening up in here. And then on the fixed income stuff, the high for the junk bonds was a year ago in June, and our advice then was to get out all spread products. And so for investors, one should be in 3 to 4 year U.S. high-grade corporate bonds. That shortness of term protects you, and you'll get a little bit better income than being in treasuries. And you also, for those outside of the U.S., you'll enjoy the next leg up in the U.S. Dollar. So that's sort of investment advice there. And the commodities, I look at serious commodity bulls over the long term, and they just don't understand it. They always figure that somewhere the world owes them a bull market because they know lots about commodities and their shortage and all that sort of stuff, but they keep coming down. And sure, we might get a relief rally in here into September on some of the big ones, but we're in a long-term bear market for commodities, and it's been on since 2011.
Well, I interviewed Simon Fraser University professor several years ago who told me, Jim, we're in for a 5-year slide in commodity prices. And again, a lot of so-called experts said the guy's an idiot.
Well, we also had a question from one of our listeners in England.
Yes, we do, and we'll get to that right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're talking to market historian Bob Hoye. Dave from the UK has a question regarding the momentum peak forecaster when it comes to gold and silver.
Yeah, that was an indicator we stumbled on many years ago, and it involves, basically credit markets. And it has a tendency, when this thing soars up, it's in the midst of a pretty strong speculation. And when it peaks, that speculation may continue for a month or so, but it's usually something very big and very cyclical on that. For example, in 2006, it was up there, and we looked around for the most speculative item, which was U.S. housing, and then published a couple of articles on how bad U.S. housing got in the 1930s, and that then turned out to be the peak in housing. But the more recent one was it peaked out zoomed up in the first part of 2011. So we looked around at the really hot items then were, of course, base metals, secondary rally on crude oil. Its high was in 2008. And with the precious metals, though, we figured, hey, this is serious stuff, and pointed out it was likely a cyclical peak for commodities. And just to back up a little bit on this, Jim, in the 2008 high for commodities, we noted that the base metal prices, deflated by the producer price index on 100 years of data, had shown the biggest percentage gain ever. And also, when it got up there, those base metal prices there stayed for a long time, which was a terrific stimulus for people to go out, find base metals, and put them in mines and put them into production. So there's huge capacity there. So you had that part, and then the final technical one was the momentum peak indicator forecaster in 2011, and indeed this then the big items there were metals, base metals and precious metals, and they have been essentially in a bear market since. And we keep looking for the equivalent bottom in these things, and we don't think we're there yet. Now, going into a financial storm, probable. One would expect the investment demand for gold to pick up because it has a unique liquidity, and so we can see a good bid for gold, but whether it bids it up in U.S. dollar terms, because the other problem in a financial contraction is that the senior currency becomes stronger. So this is where we've advised people to consider gold as an insurance position. Have some, definitely, but for gosh sakes, don't try and think you're going to make money out of it in U.S. dollars. It's there as insurance. So then the next step from that is the gold shares, and they have been beat up as well as the metal price. And the whole sector, whether you're looking at seniors to medium-sized to down to the junior exploration companies, is absolutely devastated, one of the worst ever. And yes, it will come back at some time, but in the meantime, if we have problems in the overall financial markets in the fall, gold shares, although very depressed, they won't perform. So we would keep our powder dry on the gold and silver sector until we see if there's going to be a problem in the fall. On silver, this also, relative to gold, the gold-silver ratio can be acts like a credit spread, that when you're in a financial party, silver will outperform gold and the gold-silver ratio goes down. And then when you're in a contraction after the party, silver underperforms and the gold-silver ratio goes up. Now, with the recent speculative items going on, the gold-silver ratio has again come down. So what we're watching it now, not for a trade, but for an indicator, and if that starts to go up, it'll be confirming what's already going on in actual credit spreads. So, hey, Jim, I think we've talked about nothing but warnings today.
Well, red flag at night, head for the hills. I don't know if that's a saying, but
It doesn't rhyme.
It doesn't rhyme, so it probably isn't true then. Bob, thanks a lot for chatting with us.
Good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. You can forward questions or comments about the show to info@HowStreet.com. And as you heard today, we do answer those questions. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.